welcome back to the Capital Mindset Show. Today we're going to be doing another subscriber request, and the request was for one company, but I thought about it and I can't leave this other company out. The company that was requested was Nutrien, and then I'm also going to add in Mosaic. Okay, so simply because they go together, and actually I have a little bit of experience on the back end with Mosaic. I've never worked for them. That's not what I mean, but I'll explain in this video. All right, so I think we'll begin with the one that was requested, and then we'll look at the other one too. It's good to kind of get exposure to both. So as always, we're going to first begin with the price action, have a little bit of a discussion about it, and about a little bit about the nature of this business. So essentially, this business is the largest potash producer in the entire world. For those of you who may not know, Canada is the largest country as a potash producer, and then this is the individual company that actually is the largest potash producer. So they have a huge exposure in retail as well. So they're going to talk about this a little bit, but they boast a unique position compared to their other competitors in terms of having a strong supply chain, a strong capability to get product out there to their customers. And they have a lot of other little things that they try to highlight to us as investors as to why they are, quote unquote, the superior play. As far as size, they are very large. We'll actually take a look at Mosaic afterwards and kind of compare the size, but they are a $55 billion Canadian dollar company. So that's not too far off from the US dollar. So it's still a very large company. And one thing I want to note is we are right now at all-time highs for potash, right? Potash is actually getting higher and higher because of what's going on in Lithuania. So right here, Lithuanian Railway, this story, actually, I just want to highlight this. Lithuanian Railways halts transports of Belarus of potash. So basically, potash as a commodity is actually rising exponentially in price right now. And that bodes well for both these companies that I'm going to be talking about today, simply because they are going to have an easier time getting higher margins. And I'll actually I'll show it right now, actually, because there's no harm in showing it right now. But look at this stock price chart and then take a look at this one. They're nearly identical, okay? Because underneath it all, they're connected to these commodities, right? The commodity-based businesses are heavily reliant on the commodity in which they deal business with. And you can see here the size. It's a reasonable size of 17.76 billion US dollars, and with NTR being obviously the bigger one, okay, Nutrien. So I said to you, I have a little bit of exposure to Mosaic, not in my personal portfolio. I've already asked for permission and I can talk about this. So yes, this was an investment in the company's portfolio, and there were a couple of reasons, and I'll kind of go over that thesis a little bit when we go over this company, but we've already exited the position, so it's fine. Whether or not that was a good idea, perhaps not, because, of all that's going on with the Lithuanian Railways, but that's, short-termism. It was a very good move, or a very good investment for the company at the time it was made. Okay, so I think we're going to go over to the presentation by NTR or Nutrien first and kind of skim through this. Again, this is the sales pitch. This is what they want us to think. So right here, they tell you their competitive advantages. I told you that retail section was going to be there. There it is. And then highlighting that they're the largest producer of potash, and then this nitrogen segment, right? Strategically located assets with access to low cost, very crucial in commodity-based lingo. You want the low-cost producer. Low-cost producers have power. If you are not the low-cost producer, you are the sucker. Okay. So for example, in oil, Saudi Arabia as a country is the lowest cost producer. So they can basically afford the lower prices, and they can price out competition, right? So they're very dangerous because their oil is different, right? My country of home origin, Venezuela, has very expensive oil. The cost of oil is actually quite high when compared, especially to something like Saudi Arabia. All right, so let's take a look right back here, and let's see here. So basically, they're kind of highlighting their plans going forward, their capital allocation priorities, whether or not you agree is quite important, because you don't want to invest in a business you don't agree with. You may say, I don't understand what they should be investing in. And then that's kind of a nuanced question for yourself, whether or not you should be even thinking about getting involved in a business like this. So that's about being honest with yourself and not, lying to yourself or kidding yourself that you understand a business. But that's kind of like a breakdown. Again, nothing crazy here. They are doing a repurchase program. We'll take a look at that in the model, see if that makes sense. We'll have a discussion about that. They do have a dividend. So good capital allocation for the shareholders per se, but we'll keep an eye on that. Maintain strong balance sheets. So we'll be the judge for ourselves, but that's what their claims are. I'm just reading that out. And sustaining our industry leading asset base. Okay. So they're making necessary investments. All right. I want to see that. Skipping over that. Okay, so retail locations, you can get an idea of their footprint. So they have a lot of locations: Argentina, Brazil, United States, Australia, of course, Canada, their home country. And I'm assuming United States is going to be a huge market for them. United States is almost a huge market for everyone. And then you see how I know that it's a huge market and very important to them is that they highlight the market share, right? United States is the largest economy in the world. And also it is a breadbasket nation. So a lot of their products are probably going to be necessary for the American farmland, right? And then think of Brazil. Brazil's another breadbasket nation. And then Australia, they're not, I don't think they're technically a breadbasket nation, but they're no pushover in that. Okay. So they have good exposure in these good markets. Okay. I like this. And they actually, it's funny enough, they categorize the entire thing as North America, but then they're specifically talking about United States ag retail market share is 21%, but it's in North America. All right. Going over here. So here they have the customer base, customer share, margin expansion. Okay. The key word there, margin expansion. We will be the judge of that using the model. Proprietary, we're actually going to get to that because that actually talks into the different products that they end up selling. And then optimize assets. That's them, buying and investing in their fleets, et cetera, making sure their supply chains are optimized. And that, again, everything kind of coincides into the other. So if they optimize their assets, they will actually increase margins going forward into the future. And then same thing with digital. All these two and three actually coincide with 4 and 5. All right, let's see. Low operating coverage ratio. Okay, we'll talk about that in the model. We don't need that. All right, so this is actually something that's kind of important. So this kind of breaks down their business segments. And so these are their proprietary areas. Okay, the proprietary areas. What does proprietary mean? Well, that means that that's stuff that they they invented. So other people can't really copy that. So they have moats. Right. So that's what you got to think of when you hear the word proprietary. It's moats. So then what does that mean? When they have a moat, they can probably demand higher margins. And then that's why they're highlighting this to us. And then they're showing us the margins. They're saying, hey, look at this. Look at us. Look at me. I'm doing all this. All right, cool. We give them a sticker and then we pat them on the back and then we, move on. But no, in all seriousness, we take a look at the percent gross margin and then we see what their target is. So basically what they want is a greater amount of revenues or sales coming from these proprietary products. And then they expect that to increase their gross margins into the future. Okay. So again, you can kind of see what they got. All right. So EBITDA, I don't really care if I'm being honest about this, but cool to see that it's growing. All right. And they have the two segments separated. I'll give them credit for that. They have the two segments separated. We can actually judge on that. All right. So scale growth opportunities. So future potential low cost production opportunities. Okay. So that's basically expanding their production lines, production percentage of name plate. Okay, cool. I don't want to bore you guys too much with that kind of stuff. Okay. Then this is all about their gas business. So I think I'm going to move over to Mosaic. Okay. So Mosaic is going to be quicker because they pretty much cover a lot of the same stuff, just, highlighting a little bit different. This one's not really as up to date, but they're talking about China. So this is actually, I think, 2020 report. And so they're talking a lot about China, corn imports, corn exports. So for the most part, what I want you to take away from this, and I'll actually just summarize it because I think this will bore everyone, is they're watching or trying to highlight that demand for their products. And how do they do that? Well, they measure out or they model out food. Okay. So food into the future, production of food going into the future. Okay. So from here, let's actually just go right into the models, and let's go ahead and put in our ticker. And I know I need to zoom in for you guys because of the difference. Okay, there we go. I was like, why aren't you loading in? You better not do this in front of the camera, not while we're filming. All right, so these growth rates, ignore them. We don't care about those. We're going to decide that later. All right, so let's take a look at what analysts say. Analysts have it at a buy rating with an 8.1% upside potential assumed in there. And let's take a look down at the Altman Z-score. Okay, so the model doesn't understand, and the Altman Z-score is also measuring that it doesn't know if it's going to go bankrupt. We'll be a judge of that ourselves when we go to the ratios. And let's actually jump over there. All right, so let's look at the liquidity ratios. All right, good current ratio, cash ratio could be better, but with a business like this, I'm not too concerned. Looking at the solvency ratios, okay, that's good. The long-term debt ratio is kind of maintaining the same level, nothing crazy. Long-term debt to capital, same. Okay, so basically same across the board. There's nothing's really changing in this business. It's fairly steady. Now, remember their claims. All right, now we're going to come back and remember their and kind of like say, oh, were they telling us the truth? Well, yes, the gross profit margin has actually improved, and it's improved quite nicely. Now we have to then start to question things because they painted a rosy picture. They maybe don't want to tell us that, hey, potash and all these things are at their high points in the cycle. So, they're not going to highlight that. They're going to just show you that and then, say that. But I'm going to be the word of caution here and say, well, let's be careful because we don't know what the future lies for these commodity prices. And this business and the next business are heavily reliant on these commodity prices. So gross profit margin rising most likely has a lot to do with that, not just, for example, their proprietary side that they were also highlighting. All right, so operating profit margins have actually come down drastically when we see from 30% to 12%, 12.8%. So that's interesting. That was probably something going on, a one-time expense or one-time inflow in 2017, because it's been averaging out around 10, 12, 18. Okay, so it's very cyclical. It's not liking that too much, but that makes sense because they're involved in different lines of businesses, and each of those are basically commodity businesses, so they all have their own different cycles. So actually, no, that actually makes sense. All right, net profit margin, okay, it's good. ROA, okay, it's good. ROE, it's, bland. All right, let's take a look at the earnings quality. Earnings quality has actually been fantastic except for 1 year. Okay, and so that was 2018. So in 2018, it was not a good year. Let's actually take a look at the price and see if we see some kind of correlation. There was just a dip, but it subsequently fell. But yeah, there was a dip in like 2018. That's about it. Yeah, and remember, always the score is measured throughout the year. So yeah, towards the end of the year, there was this dip. But then again, in 2018, there was a dip of a lot of things. Okay, so because it was, yeah. I don't know what we can attribute it to that. Remember, it's correlation, not causation. So that could just be correlation. All right. So book value per share, this is a business that has a lot of assets. We could consider book value in a business like this. Other businesses, no, but this business, yeah. Let's take a look at the activity ratios. Okay, cash conversion cycle, interesting. Let's see. I'm assuming that inventory is a little harder to get. They're getting better prices on that inventory, but it's a little harder to move in the more recent days. Day sales inventory. Okay, no, actually, they're selling this inventory out. Well, it's a drop from 2018, so it's worse. This got worse. This got worse, but it's better from than 2019. So they are kind of on the uptrend on the cyclical side. Yeah, the cash conversion cycle though has well, I mean, it's not that crazy. It's nearly a double, yes, but this is not a business that would concern me too much. Okay, again, nuance with everything, but yeah, there's a lot of things here that actually got a little bit worse. And guys, you guys can always pause the videos on these, and then you just follow this column, and you can kind of judge for yourself whether or not things are getting better or worse. That's why the column's there. All right, so let's go to the summary report and make our judgments. So average growth of the past years, I'm not going to include that simply because has to do a lot with what happened, what's going on. So let's take a look at the trend line and see what happened. So the sales, okay, this is definitely acquisitions and the such. So that's why we see this massive uptrend. And so that's messing up the trend line and it's exaggerating the growths. So the cash flows, however, they are kind of reverting back. So it seems like they're not able to catch up to cost, which is quite interesting because the stock price isn't actually reflecting that at the moment. So I'd say that this one would be a very difficult one. I'd say let's start experimenting. Okay, so with the cash flows, let's see, they had, yeah, we can use this calculator down here actually. If they had a recovery period of about, I'd say, yeah, that's pretty conservative. I'd say that's pretty conservative. So let's see what a 10% growth rate would imply. A 10% growth rate would be not in our alley, and that would be fairly low, by the way, because I'm implying that they only have a recovery period of about 8 years, which would be very extreme in my opinion. But you know, who knows? That actually could happen. This stock price has actually roared. Remember, we were at in the 50s in 2019, and if we take a look at, oh, that's all I have here. So we are at a much higher stock price, so we might be pricing in a lot more success from the business than might be realistic to imply. We are doing a lot of buybacks, so I think, let's say they can buy back about 5% of these shares going forward, or maybe a little bit more conservative, and we do the classic 2 to 3%, but let's stick with 4 for now, and let's see what we can make of it. So if they do that and they grow at 10% in the cash flows for 10 years, we can assume a 10% required rate of return, and we're basically there at the price today. I don't like these odds. For one, I'm not so confident in this growth measure because, again, it's a commodity-based business. We would have to really look at the macro scale or the macro landscape and see what's going on with potash, what's going on with the main producers of potash. Are they going to come back online? This is akin to the trade I made in oil, which I'm still in. I only sold 20% of my ConocoPhillips position. I still hold all my Gazprom position, and the remainder 80% of my ConocoPhillips position. I might be selling more soon. And I need to do a dedicated video on simply when to sell a stock, right? But go check out that video on ConocoPhillips, and I do explain why I'm starting to take profits. So the required return of 10%, let's actually increase that to 15%. Let's get that margin of safety working in there. So now we do have to assume higher growth rates. And again, I'm not so confident in that buyback range, okay? Because that's assuming a lot, right? And especially since now that the price has gone up, and actually, that's what this tool is for over here. So you can kind of see what their capability is right now if they were to dedicate the entirety. So even with that 10%, it's telling me that they would basically be borrowing money in order to do so because they don't have the cash flow sufficient to actually buy back shares. So let's actually assume the 2%. And because if we put 3%, they're basically using up the entirety of the cash flows. We would be almost at the price. But again, you see, we do have to start assuming probably higher than 10% growth rate. And is that possible? Maybe. Is it likely? I don't know, because we're in the high end of the cycle. How long will this continue to go on? These are questions that you would have to ask yourself as an investor. Okay. So let's see what a good margin of safety would indicate. I'd say with something with uncertainty, if you don't really know, you need to have a huge discount rate. I wouldn't even assume this buyback. And now we can start to see what are the assumptions we'd have to make in terms of growth. So what I'm going to conclude about this company is it's extremely overvalued at the moment. That's kind of just my preliminary thoughts. A lot is being priced in. We are in the moment of exuberance for this stock, for this company as a whole. They're not really going to be telling us in the investor presentation why the price of potash is so high. There are many reasons why it's so high. And then the Lithuanian railway thing was just added fuel to the fire. I think they all rose like 8% in a single day when that happened. So this is, you know, these are more difficult businesses to analyze. You have to have a more intimate knowledge or understanding of the underlying commodity. And from there, you can derive an assumption that can then reflect itself into your assumptions, okay, for going forward. All right, let's go move over to Mosaic. Let's see if we see anything different. So let's zoom in again, and then it's MOS. Let's see what the analysts say for this one, because I'm actually curious. Okay, so this is the one that we have already liquidated. It's already out of the portfolio, so I'm allowed to talk about it. And the reasons why we bought in, we started buying July and then bought more in November of 2020, and then we sold in December of 2021. So we made a good amount of money on that one. It was a good trade. And what this again was the belief, or our conclusion was, we don't know, or we can't drive with a high degree of confidence what the underlying commodity prices will be going forward. And so because of that, the position presented added risk. So we wanted to take out that risk, take the profits, reinvest it elsewhere, or just hold it in cash. Okay. So again, I can't say what we did with that, but I can say what I would have done with it. I never held this in my portfolio, just so you guys know. All right. So actually, we got to go to the ratios, Fabio. We can't just dive into that. All right. So we'll quickly go through the ratios. Liquidity, great. Same as the other company. Total debt ratio, same. They're pretty much the same, actually. That's actually really funny, because just so everyone remembers, I'll have them up here. They're literally within the same range, not too far away. Very comparable. Okay. It's also funny that their stock prices moved almost the same. All right, so gross profit margin, same thing. And the same commentary I gave it before. It's mainly probably to do with the underlying commodity rising price so much. So they're experiencing great margins right now. Okay, so taking a look over here. Oh, they didn't even have a single year of earnings quality being below 1. Awesome. I really like that. All right, it's really cool. All right, so book value per share, again, we were actually adding to this below book value, which was funny. That was actually one of, I remember when we were talking about it at the firm, this was one of the things that was interesting to us, okay? Because companies like this, when you can get them below book value, that is favorable. It's not the main thing. It's not the main bullish point, but it's also an added benefit, or an added nice situation, scenario, factor. That's the word I'm looking for, factor. All right, taking a look down here, let's take a look at the activity ratios, kind of like the same story. Nothing's really different from here. All right, so I think I'm going to go to the summary report, and let me announce what the analysts say. They have a buy rating implying 2.7% upside with a price target of 48.13. Okay, so basically the analysts are, we probably agree with the analysts, or I would agree with the analysts too, because, again, we already liquidated, and we liquidated around these prices. So, they're basically saying we're basically at fair value right now. Let's actually assume the same thing. Let's start with the 10% discount rate, and let's assume the 10% growth in cash flows. We take a look at the average growth of the past couple of years. It's about 10%. Taking a look here, they don't have that crazy fluctuation, so probably not an acquisition. And they're falling more in line with trend line. We can see clearly the cyclicality of their business. So the ups and the downs, and now we're in an up. Are we going to go back to a down? I don't know. And then we see the same thing with cash flows. We even dipped negative in 2019, and now we're just going blasting off positive. So I don't know what this would entail going forward. So a lot of risk already priced in, because even if I'm growing above, right, the long-term average growth rate in the revenues, I'm not even at a 10%. Again, showing what are we in. Right now, we're in the era of exuberance. We're not buying it, this stock, if we're buying it. We're not buying it when everyone hates it. We're buying when everyone loves it, right? Everyone's going, oh, potash is scarce. Buy potash. Okay, yes. Everyone's already thinking about that. They're already in the trade. If you haven't been already in the trade, you missed out. It's kind of over. That's my opinion. You may disagree with me, and then please comment down below why I'm wrong. And then we can start the conversation like that. Okay. So max buybacks. Well, this has actually been dilutive, funnily enough, but so let's actually say that they dilute. And by the way, everyone, and that's a 200%. By the way, everyone, if you think the business is overvalued at the moment, I was going to go over this at the end, but I think we're basically at the conclusion of both. Both of these companies probably should not be buying back shares. They should be actually diluting you. If you believe in the long-term longevity of the business, and if the management wants to do what's best for the business over the long term, this is the moment where they actually should be diluting you. And look at that, silly little dividend yield. And let me make sure that Google and I have the same one. So we're about the same. Probably porting in a little bit off. But yeah, we're about the same dividend yield. We're off by a little bit actually. So this dividend yield, I call it like a token dividend. It's a cute little dividend. That's kind of like the cost every time they issue new equity. They're going to be paying that. That's not the actual cost of equity, by the way, but that's one way of thinking about it. So at this present moment, if I was the management, if I was in the management position, I would be actually issuing shares. Not like crazy, because I'm trying to destroy value, but I would be trying to get as much capital as I can from the capital markets, and then investing it as the cycle goes into a downturn, or maybe at that point buying back shares for cheaper. Okay. So, but at this point, I would not be so confident in saying that the price of potash will, or all these other commodities that these two businesses are involved in, would continue where they are today. I think that the uncertainty that I see going forward is, it makes it very cloudy. I don't really know what growth rates to really apply here. Let's see if I apply this 20% or 15%. Okay, so we're at a 15% and we're still only at a 10% discount rate. See, if I want any form of margin of safety, the growth rate that I'd have to assume is rather insane. Like, let's take a look at, for example, 20. It doesn't understand what I meant by that. All right, so yeah, you see, even with the 20%, what would he have to assume? 50%? Okay, well, 50% is a little overkill then. 40, let's see. I'm exploring with you guys here. 35. Yeah, 35, 33, around 33. 33% is what I have to assume. Can you really assume that? Like, really? Probably not. So now you can kind of see why we sold out. The risks kind of outweighed the added benefit. So, but again, with all these kinds of businesses that are commodity heavy or rely on the prices of commodities, they're very difficult to analyze. They're very difficult to model out. They're very difficult to project. And you actually want to get them literally when no one wants them. When no one wants them, that's when you want to pull up these companies. So again, to reiterate, if you go back to the oil company videos, the oil companies were not wanted, especially for some reason, because they thought the Team Blue was going to win. And when Team Blue won, actually turned out to be a very good investment opportunity. No one wanted them. You just bought up any big oil company and you did great. Okay. Even the Russian oil and gas company, Gazprom, in my portfolio was a very good investment. I'm still up over 100%, even though it's pulled back a bit. And I might do a video on that one, because that's an interesting business. It is a foreign investment that I hold. It pays a good dividend for me. And, I'm not actually planning on selling it. I'm waiting on to see what kind of occurs. And then I have my ConocoPhillips that's already designated as a sell on my portfolio. And then as I liquidate that position, I may or may not buy more Gazprom, may or may not, there are a bunch of investments I'm kind of waiting on. So on that note, guys, if you guys like content like this, go ahead and feel free to leave a like button. If you have any questions about anything discussed in this video, go ahead and comment down below. If you're not subscribed, consider subscribing for more content like this. And if you have a request, again, comment that down below as well. All right, on that note, guys, I hope you guys have a great one. Bye.